Welcome to the Pengana Australian Equities Fund market update. I will be speaking for between 5 and 8 minutes and hoping to give you an update in a succinct fashion on currencies in the market, where we think the market's heading, and importantly, how do we have positioned the portfolio to cope with these forecast issues. I will be sharing my screen now on a presentation pack and run through the slides. Hope you enjoy the presentation. So firstly, our cover page shows that major issues we're focused on is the runaway inflation, particularly in the US, to a less extent in Australia, and the ability by governments or central banks to raise interest rates to rein it in. We're very focused on this because our mandate is to preserve and grow the purchasing power of your money. At the moment, if you leave it in cash, you go backwards by 3 to 4% domestically, and in the US there's a bigger problem of going backwards in your real value by about 7. The fund's performance has certainly achieved this risk-free rate plus 6% over the longer period. In more recent times, we know we have some work cut out for us to make it back, but the position of the portfolio is extremely well positioned, and we're confident that will resume the upward trend very soon. So what's happened this year calendar to date? First of all, during reporting season, which occurred in February, we got some remarkable insights into corporate Australia. And by and large, we were very pleased by what we saw. Very strong domestic economy, certainly getting stronger, and healthy dividends have been harvested, which has provided further confidence. Secondly, inflation has arrived, both here and overseas, and it's through a combination of stimulus generated by governments to try and get the economies out of the problems associated with the pandemic, coupled to very widespread supply chain issues. And they've been large and persistent. Portfolio is well positioned to cope with this, and we've certainly taken a lot of positions that in companies that will actually benefit from inflation, and I'll go through those in a second. Thirdly, this unexpected war between Russia and Ukraine. You have one of the largest energy producers in the world, going to war with one of the largest wheat and soft commodity exporters in the world, and this has created enormous difficulties for most manufacturers, as input costs of most commodities have gone up significantly. While you never want to take advantage of other people's misfortunes, I must say that Australia, and given its large agricultural surpluses, its energy exports, both in coal and LNG, and obviously iron ore, have benefited enormously from this situation. So very central to our investment thesis is the fact that we follow the long history of US Treasury bonds, which is the global cost of money, very, very closely. And what you'll see is that since the 80s, we've had 30 years of ever declining interest rates. Wonderful time to build an asset base, but certainly we think that party's over. And going forward, we think it'll be quite different and quite difficult. We think the way forward is not to buy tech stocks that will make no money for 5 to 10 years as they grow their revenue, but rather to harvest blue chip companies that are capable of throwing off enormous amounts of cash. And that's the way our portfolio has been positioned. Certainly this chart demonstrates, or this collection of charts demonstrate, the unsustainable level of interest rates, and we think they have to go higher. So just to unpick it, on the left, you've got what the situation was in June 2021. Most of the countries we consider important, what their rate is, or their central bank equivalent rate to the RBA cash rate, what the rate setting was a year ago, what CPI was a year ago, and therefore the very, very high negative real interest rate available to savers, massive impost. The last move as well was generally a cut as governments tried to stimulate their economies. Fast forwarding almost a year, and two things are very different. First of all, most countries have lifted interest rates or in the process of lifting interest rates, we see that even though the US has lifted its interest rates in March, the much higher CPI or inflation level in that country indicates that they've got a long way to go. As we can see, you're currently losing over 6% to have money in the bank. So inflation is spiking after 30 years of relative stability, and I would put to you that there are not many managers who know how to manage in an environment of inflation. Even myself and my team, coming out of South Africa 26 years ago, we had quite high inflation then, but that's a long way away. So how have we positioned the portfolio? First of all, most of the portfolio is in defensive companies. Beige is boring, and so we've color-coded it. These are companies that are economically insensitive, have pricing power, and have inelasticity of demand. And essentially, that's a fancy way of saying they're able to successfully pass on higher input costs to their customers without losing volume, and so generate decent returns for shareholders. The after-tax cash earnings yield, that number that we as greedy shareholders can scrape off these businesses and put in our pocket without damaging the businesses, is quite high at 7.5%. In fact, it's even higher at the moment. This is a portfolio snapshot as at February, and it's currently at about 7.8%. Now, I've never seen the portfolio at these levels before, and so we're super optimistic about the outlook for our companies. Importantly, we also have taken the additional position of some options for defense. So should the market fall off these elevated levels, we're well protected, and cash, after harvesting those very healthy dividends that we spoke about, stand us in good stead. Lastly, I want to talk about one of our hard assets and why we think the portfolio, we're using Telstra as an example, is well positioned for the upcoming inflationary period. So Telstra, we think, is a hard asset. On the far top left-hand corner, you can see what you're actually buying. So 55 cents in every dollar is the mobile phone business. It's dominant. Its product is incredibly economically insensitive. If any of you have got kids in your homes, you'll know what it's like to try and take away Wi-Fi or wireless data from them. So this is a business that's revenue is incredibly sticky. Also, its other two assets, the 20% NBN income stream and the Telstra income infrastructure assets, are directly linked. Their revenues are directly linked to the level of inflation. So as inflation goes up, the amount of payments they get go up. And because their fixed cost base, or the cost base is fixed, all that extra money drops down to us as greedy shareholders. Importantly, we can buy it at the right price, and we think that the cash flow will grow from 6% to 10% over the next 4 to 5 years. Thank you very much for listening, and I hope you found that useful.